Dear investor, in this session we shall talk about 1. The ongoing result season, 2. Why we believe there will be alpha going forward and how are we going about it, and yes, valuations amongst other topics. To start with, Q4 result season. The ongoing result season has been more or less as per expectations, with Nifty sales, EBITDA and profits registering a growth of 14, 15 and 20%, a tad better than expectations for the 43 companies which have declared results till yesterday, 22nd of May. Broader universe saw a PAT growth of 19%, indicating good breadth of earnings. Now, metals have been a drag, and excluding metals, broader coverage universe EPS growth has been much better at 33%. Another cut, BFSI and Autos have led the earnings growth, and if we exclude BFSI, earnings growth has been just about 8%, which is quite okay. Larger software companies saw downgrades. Overall, we continue to expect FY23 EPS to be around 812 levels, unchanged from earlier expectations, and financial 24 EPS to be between 950 and 1000 on the Nifty. Coming down to the next topic, Indian macros. Macro situation is getting better, though growth could slow down. We keep tracking forex reserves as high, and improving level of reserves point to improved domestic liquidity and more policy independence with RBI. RBI has stopped increasing interest rates as it coincided with our forex reserves climbing, and as our import cover improved. At the same time, trade deficit over last 2 months has indicated narrowing, and the current account deficit in financial 24 is expected to also narrow. So outlook on forex is much better. WPI inflation has been reducing consistently and is now in the negative territory. WPI inflation for India. China's annual inflation rate has also declined and unexpectedly came in below 1% at about 0.7% in March. Now, this points to improved prospects of US inflation rate to also continue to decline as we go forward, because China is the factory for the world. Reduced inflationary pressures would increase the case for a drop in interest rates. Drop in interest rate would be good for prospects of risk assets like equities, and within equities, strongly growing businesses with large terminal values such as the new tech should end up benefiting the most. Financial 24 is the year when economic growth is expected to slow down, both in real and nominal terms. With growth in money supply reducing globally, global growth rates should be expected to stay below potential. Indian export growth is already showing a decline. Another factor is that now the economy's bounce from COVID low has ended, and the growth rates are normalizing. 3-month growth indicators in most spaces are mostly flat. Coming down to the next topic, time for alpha. We believe, as the low base effect wears out, businesses which are able to grow strongly even now would start to command a premium in the market. In the last month, we had shared a view that as we go forward and growth becomes less omnipresent, the high quality growth style of investing should again start to get very competitive versus the value style of investing. We believe the following spaces should be able to generate significant growth alpha over the index and the reasons for the same. So first, is the financial space. There we believe faster growing retail oriented private banks could be the space that does better. Financial 23 was a year of 15% nominal growth of GDP. Financial 24 is expected to be just about 10.5% as per budgetary assumptions. This implies that the system lending growth, which would be required to fuel this growth, would also be lower. Lower inflation would mean corporate working capital focused banks would find it more difficult to grow. For banks which are focused on retail, however, it should prove to be business as usual, and they should be delivering stronger growth in line with what was delivered in financial 23, and that is our focus. Second, new age tech businesses. One reason we have shared, but the other one, is that these businesses have now built up their brand recall and have gained significant following. Most of these are now focused on profits versus market penetration. The reduction in many of these businesses have been very sharp. Reduction in losses in many of these businesses have been very sharp, and it is quite clear that the trajectory would sustain over the next period of time as well. Hence growth should sustain, growth in profit should sustain deep into the future. Third space is hospital and hospital infrastructure. Now here there are two drivers. One, India, while India is a young country, it's also rapidly growing, and age cohorts of over 60 are seeing sharpest growth in numbers. This is the age when health requirements increase, and people, coincidentally, people also have savings and the ability to pay for it. And of course, health insurance. Second, while health tourism reduced during the COVID period, after COVID, it's starting to normalize, and that should also benefit this space. So that was our third one, and now on the consumption side, we believe premium discretionary consumption space should hold out much better versus the broad spectrum or in the broad spectrum of consumption. Once again, the premium end of the market gets less impacted in an economic slowdown. Categories like jewelry, weddings, and office wear should prove to be resilient in the space. Engineering and defense capex is the other space where we believe growth of the similar order as was delivered in the past period could sustain. Make in India continues to be a big focus of the government. Recently, another list of defense products for domestic manufacturing was brought out, so that story continues. At the same time, India continues to endeavor to build new age manufacturing expertise. Companies with technologies to help India achieve its dream have a good chance of continuing to show strong order book growth. Government, which was the sole driver of capex earlier, but now increasingly private sector is also beginning to participate. Lower debt to equity of large businesses help this cause as well. At the same time, banks are in good health with low NPAs, and the picture here looks good. Housing, the other big driver of capex, is also seeing an upswing. Next theme that we are focused on is China +1. Increasingly, it is becoming China -1 in terms of how the world would want to source its various goods. De-risking away from single geography is top of the mind thing globally. Earlier, countries wanted to have another second supply source apart from China, but now increasingly the sentiment is that we would source from anywhere but China. That's starting to happen. Many businesses are benefiting on this count. Government of India has rolled out PLI schemes across the board, and we have seen many companies come up in the EMS space. Chemicals as a space are a big beneficiary of this move. Listed companies are increasingly looking at new growth areas such as lithium-ion batteries manufacturing, solar cell manufacturing, hydrogen electrolyzers, electric vehicles, etc. And players in the ecosystem would see relatively stronger growth. The next theme that we are focused on, and this is a very narrow theme, is to focus on mid-sized IT companies focused on growth verticals. Now, Q4 has been mixed for IT companies. Many large IT companies have seen issues in BFSI and discretionary spends. However, smaller IT companies focused on growth verticals have done relatively better. This trend could continue as verticals like airlines and hotels, benefit from travel reflation. Auto vertical benefits from upgrade into electric vehicles and connected cars. So there is a technology change that is happening there. Telecom vertical is expected to benefit from 4G to 5G transition. And in terms of geography, Europe, which was lagging behind the US in terms of outsourcing, is now joining the bandwagon, and larger mid-cap IT companies are also benefiting, from having crossed the size threshold. So they are still large, but they are over. They're still small, but they're over the minimum threshold required to qualify for large projects, and are hence qualifying to see more deals and winning some of them. Also, many of the smaller companies in the IT space have seen credible changes in the top management. We note this with a lot of interest. Our portfolios focused on the QGLP philosophy across the board have a fair representation of the above growth spaces. If the thesis plays out right in terms of growth premium being accorded to spaces where growth sustains at higher levels, then we believe our funds should be able to deliver significant alpha as we go forward. High quality combined with sustainable higher than economic growth is what we are seeking. We believe that with gross fixed capital formation reversing the downward trend, and with private final consumption peaking out over the past 2 or 3 years, beneficiaries of capex theme with pricing power could benefit over the consumption theme. We note that space like FMCG, and their let's look at XITC, has seen its P expand from 20s kind of levels in 2006 and thereabout kind of a period to over 50x now. Consumer discretionary similarly has seen P's expand from 20 to 70 over the same period. With earnings spread now more broad-based, and we saw that in the Q4 result season as well, versus the narrowing earnings that we saw in the period from 2012 to 2020, something that we covered in the last video and write-up. We do believe that consumption space can see some price consolidation, while other spaces, as highlighted, take up the performance baton. Coming down to the next topic on valuations. Well, markets have moved up over the past month and are again over 18,1200 levels as we speak. As we have been explaining previously, our fair valuation construct is 18 to 18.5 times 1 year forward. EPS, given that financial 24 Nifty is expected to have an EPS between 950 and 1000, we continue to believe that valuations are fair, particularly also adjusted for the fact that in the new year we have to adjust for 2 months that have gone by. Market should hence be expect to see performance tracking earnings growth going forward. Second thought here is when we compare equity with debt yields falling, now a 10-year is just about 7%. Equities have become competitive versus debt on a pre-tax basis as well. With now debt returns being taxed on marginal income tax for investors post-April, equity has become very competitive versus debt on a post-tax basis. If we look at another class of investors, which is the foreigners, so expect domestic flows to continue, but at the same time foreign yields are still very high, and we expect foreigners to continue to be debt focused, and hence flows into emerging market funds could be low. In the past period though, India saw strong inflows. This may be more due to weight changes, and maybe money moved away from China, a market which has underperformed. In the coming period, once again, there can be some amount of reshuffling in weightages amongst the emerging markets. There is an expectation that Korea may be designated as a developed market in the MSCI indices. Let's see if it happens. Now, if that happens, India could be a large beneficiary as the weight of Korea gets distributed amongst whoever is left in the bucket. Even otherwise, we expect some passive inflows into India as some of the large banks become part of the MSCI index. And while this is happening, we could see the broad market performance lag a bit while the indices, which are more large capish in nature, perform. With that, thank you. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.